Well, I mean, I'm not concerned. It's something that you want to adapt your game plan for. It's you want to be more selective with tech stocks. It's something that I've been pounding the table on for the last few months. You want to have commodity exposure too, as long as where you're seeing right now the Fed they're priced into hike rates about three times this year, but it's about a almost 90% probability coming into the CPI number. It was about a 70% 90% they lift off in March, and a 70% they do a second hike in June. If you combine those two together, I mean, your commodities should not be derailed. They're not going to really disinflate the environment by hiking now because the market's prepared for it. So I think if anything, we have some peak hawkishness, which could be a near-term top in the U.S. dollar. Another few reasons why I'm looking at that too. But that I'm looking at as being a tailwind to commodities. And I think commodities within your portfolio help diversify right now.
You mentioned a 90% probability of liftoff by March. Have markets adequately priced that in yet, Bill?
I believe so. I mean, that's what we saw really early part of December, middle part of December, and then really mostly hitting us through last week. When rates were rising, you had the 10-year get to 1.8%. That was the environment pricing that in. And that not only so was the environment pricing in the other hikes too, or looking at high probabilities of those. So I think we're at a point where this is digested by the market.
Okay. And are you seeing any fear at all? Are you looking at something like the VIX, for example, and tracking what's going on there?
Really, what I'm looking at is from a positioning standpoint more than anything. I mean, look what happened with the Nasdaq and the broader markets through this Monday, and there was definitely some capitulation. It was indiscriminate selling. So what we did on Monday was put a note out to our clients, the video out to our clients, and say, listen, over the next 24 to 48 hours, we're going to understand whether this is indiscriminate selling and the market has much lower to go, or are we going to see a nice low come in come in here that early Monday, and the markets are going to be able to consolidate from there higher and into Fed Chair Powell on Tuesday and the CPI on Wednesday. And that's what they did. So the markets are still playing to a narrative right now, that narrative being the path of the Fed tightening.
You mentioned earlier that you might want to ease up on tech stocks. I'm just curious as to why that would be.
Well, the high multiple names within tech right now. I mean, that's the high growth, high multiple stuff. And those are what's going to hit the hardest. I mean, as interest rates rise, I mean, those companies don't make money. They're borrowing money, and their balance sheets do not work in a higher interest rate environment. So where rates are very low, investors, they don't have a place to put their money, and they don't have a place to invest capital because you're not making any money in a savings account or a 10-year treasury. But now, as the 10-year gets back closer to 2%, where we see it today, and I think we may have a 2.15 ceiling, then investors have a choice now. They could get 2% rather than taking the risk of these high multiple names over, that are even as high as 60 to 100 and PE. Those were getting hit pretty hard through Monday. So, I think it's just a different environment looking at value and cyclical stocks, commodity names. Look what Freeport McMoRan has done. Look what Cleveland Cliffs has been able to do over the past couple of weeks. Mosaic as well. You're seeing commodity names that have done really well. And obviously underlying commodities have done very well. And then looking at value names. I mean, well, obviously energy names, Chevron is completely broken out right now, Pioneer. But then you also want to look at the other value names with industrials and banks, and there's really, that's where we want to be. We're positioning in our portfolio. We're not throwing out all the tech, but we've really ramped up our overweight exposure in the value names.
All right, Bill. So are you saying that there's going to be a sector rotation in 2022?
Well, it's already occurred. I mean, that sector rotation has already started. We've seen a big move over the past week, sort of a vicious move, if you will. I think that continues. And so I don't think you're late to the party if you're just doing that now. But we use a number of models to manage risk, whether that's put structures below in order to hold on to some tech, whether that's the rotation itself, and we're doing a mix of the two.
And so what sectors would you be overweight then this year?
Right now, we've been overweight energy, and we've been adding to energy even through December. Use the sell off on the heels of Omicron after Thanksgiving as an opportunity to become overweight energy. That energy itself is about 2% weighting. Maybe up to almost 3% weighting in the S&P 500, and we hold that with about a 10% weighting right now, and half for a bit. Banks, they're about I think it's 11% weighting in the S&P 500. We're overweight with closer to 15 to 17% weighting. We do have some names that we sort of maybe a little quicker to the trigger with and take advantage of. But the banks have really, especially regionals, have really run pretty far. And I think you don't want to chase those into earnings, because the bank earnings do kick off Friday, and banks haven't really performed so well after earnings, but I think you'll find some buying opportunities after. Healthcare is a place we definitely are overweight and want to continue to be, with more than the 20% weighting in the S&P. Compared to our portfolios.
Okay. Oil, banks, they don't sound like defensive. So are you saying that this year is still going to be the year for cyclicals? Are we still going to see risk on appetite?
Yeah, I think this year is going to be, it's a year where the cyclicals are going to outperform the high flying tech. And I think you want to stay nimble. Look back at last year. And last year we had the Pfizer news on early November. You saw a lot of the reopening stocks just surge higher through much of November, and then we started the year off 2021 with banks outperforming, energy outperforming. So you want to stay nimble in the sense that over the next few months, we're going to see the Fed's path a little more closely and have some answers. And what right now, as the new year's underway, it's definitely a stock picker's market. It's a sector picker's market, but that doesn't mean, like it was in 2021 last year, that once we get to the middle part of the year and we have those answers of the Fed and the Fed's path, we have some answers on growth, we have some answers that then allow those high flying tech names to outperform. So I think as we have that sort of playbook from last year right now, just at a higher place in interest rates than we were a year ago. But it's a very similar playbook, and that's why you want to stay nimble as we move, and get answers in through May and June.
And what about the recreation sector and the travel industry? Airline stocks, cruise ships, restaurants, hospitality sector. These things were doing well up until Omicron hit, and now we have people getting scared and being shut down and locked down. So yeah, how does this story play out this year, do you think?
There's some stocks really performing well, even despite Omicron. Expedia is a name that we own. We've owned it for quite a while now, and Expedia has moved really up to its high at the moment. MGM is another one that's performed pretty well relative to the other casino stocks, gaming stocks. But I think that just goes to show that it's a stock picker's market. You can't just indiscriminately own a number of airlines and see and then face some headwinds. I do think though that there is a place for them in your portfolio. Like I said, we do own Expedia and MGM, but we are selective, and it's something that you want to continue to be.
Okay, let's move on to the precious metals now. Gold and silver, they don't do well during rising interest rates. Now, that's not to say that real interest rates will rise, but that depends on inflation, right? So first of all, how do you see real interest rates developing in 2022? And second, how will that impact gold and silver?
I'm really glad you brought this question up, because this is something that I've been hitting on recently for clients and talking about quite a bit. Is